What sticks out to me is negative free cash flow projection for 2019. They're saying similar to this year, which is about $3 billion. No erosion of that. And for the first quarter, the guidance on net subscriber additions is similar to Q4 under the new pricing. So I think maybe investors are looking at that and saying, okay, it looks like they have a decent read or relatively decent amount of confidence that they can maintain this level of subscriber growth with the new pricing. And also Q1 repeating fourth quarter pace of net additions seems okay. I mean, I think it's sort of an on-course type of story. And also after this year, they see obviously lower free cash flow burn because they think margins will get better. So maybe they kind of see that tilting toward profitability on a cash flow basis in the not too distant future.
Which is one reason that Stephanie analysts were so excited going into this print. They saw this as sort of an inflection point for profitability. The sub misses, they were minor.
Yeah, I mean, the stock is up 50% post-Christmas. There was nothing that this company was going to print that the stock would be up huge, unless it really was blow away.
Are you surprised that it's not down bigger?
No, because I actually think the first quarter sub numbers are better than what a lot of people were thinking. So that's encouraging. I think the big questions, though, are really what is this price increase? What is it going to do to churn down the road? And at least in the near term, for guidance, they don't expect a material impact. So that's a good thing. But this is going to be, throughout this year, we're going to be constantly monitoring, obviously, subscriber numbers. And that has always been the metric. And now we're even more so obsessed because we want to see if it's going to lead to further churn along with the competitive environment.
We're going to get Chris's take in just a moment, but Julia's got some more, been diving through some of these numbers and some of the comments. Julia?
Yes, well, just want to talk to you a bit about guidance. Now, the company provides guidance for its first quarter, and the forecast for both revenue and adjusted earnings per share is lighter than expected. The company guiding to diluted EPS of 56 cents per share. Wall Street expectations were for 83 cents per share. Wall Street expectations for revenue was for $4.6 billion, the company guiding for $4.49 billion. But what's notable, though, is that the forecast for net additions for the first quarter, paid net subscriber additions for the first quarter, is actually higher than Wall Street estimates. Netflix projects global net paid additions. So, of course, I just want to highlight here, they're talking about paid, not total. They're going to start excluding all those free trial services they gave out, was 8.9 million. That's 8% higher year over year. That's higher than the 8.38 million that Wall Street analysts had been projecting. So just want to highlight the lower than expected revenue and earnings outlook for the first quarter, whereas subscriber additions for the first quarter was better than Wall Street analysts had been anticipating.
And when do we expect these price hikes to start to take effect, Julia?
Well, so some of them roll out immediately. So if you're signing up to Netflix for the very first time, that was effective Tuesday. For the rest of the subscribers, they're going to be rolling out over the next couple of months. So between now and the next 2 months or so. So that what's interesting there is that it sort of depends on also when you start. When you started your subscription and when you start paying. But the last time they raised prices in fall of 2017, they did not see a meaningful impact. There is a comment here from Hastings talking about the price hike. He said, "We change pricing from time to time as we continue investing in great entertainment. We want to ensure that Netflix is a good value for the money and that our entry price is affordable." He talks about increasing the pricing, says it will be phased in for existing members over Q1 and Q2, which we anticipate will lift their revenue. Now, he talks about how they are going to continue growing their content while increasing the revenue faster to expand the operating margins. Talking about how they're targeting a 9% operating margin in the first quarter, which will grow over the course of the year. So he's definitely, talking about this, the price hike, but it's all about having more content to make it worthwhile.
Okay, Julia, thank you very much for that. Let us know if you get any more. Chris, talk us through how you think about this company and its valuation.
Sure. I mean, as Stephanie mentioned, the stock's up a lot already this year, so it was pretty much priced for perfection. There's always going to be noise in these bets on the future, and so some noise here is probably not going to be a bad opportunity for long-term investors if it does pull back to deploy capital in it. The management team over years has certainly proven that it's been able to fight through some headwinds and changes in pricing with their customers. I think they've also proven to be flexible. And they've also seen the future where owning content is going to be more and more important. So if you look at the cash flow and they're reinvesting in their business, that's probably not a bad thing because they're investing in the future, and that's good for long-term investors.
As long as they can keep adding subscribers. Ed Lee, what else is standing out to you?
Well, so I think it's actually very notable that they're not giving us the total subscriber number like they had been for years. I'm reminded a little bit of, Apple sort of discontinuing giving us information on their unit sales. It's not quite the same thing, but it's still getting less information. Of course, the paid subs have always been the most important thing, but to sort of stress the point, they have this nice little chart here showing the projection in paid subs. That's going to be important, but I'm missing that data point. I think it was an important thing to know in terms of a sense of the churn, a sense of how their marketing is working, and they really want us to look at a different number now, or at least focus on a different number. I'd rather have the other number as well. That's a bit of a disappointment. But
is it as big a factor as when Apple switched how they were reporting?
It's not quite the same, but it's telling, right? Going forward, I think they're looking at trying to find a way that that growth will sort of level off a bit. And I think this is an anticipation of that. I think it's also notable that they're missing on the top line. They beat on the bottom line. It's similar to Q3 for the big tech giants with Amazon and Alphabet and Facebook having similar situations where their top line missed, but their profits were actually better. So I think there's a bit of a slowdown in terms of the top side of this. And that's the thing to look out for. International is going to be the most important part for Netflix going forward. That's where the real growth is going to come from.